Premature Alarm. This editorial discusses Pakistan's current account deficit and related financial challenges, arguing that current worries may be short-term. Last month's $420 million current account deficit reflects the pressure of debt payment and a rising import bill on Pakistan's balance of payments position amid drying up foreign loans and falling foreign private investment. Current account deficit refers to when a country imports more goods, services, and transfers than it exports. $420 million means $420 million. Pressure of debt payment indicates the burden of repaying loans, while rising import bill refers to increasing costs for imported goods. Drying up foreign loans and falling foreign private investment highlight decreasing external financial support. Overall, this sentence explains that last month's deficit was driven by high debt servicing and a surge in imports, compounded by reduced foreign financing. This gap most likely marks a temporary reversal of the earlier trend of continuous surplus posted for 5 consecutive months, August to December, on account of a substantial boost in remittances from overseas Pakistanis. Temporary reversal means a short-term change in trend. The sentence contrasts the current deficit with a prior 5-month period of surplus, which was largely due to a significant increase in remittances, money sent home by Pakistanis living abroad. The remittances have recorded a surge of $5 billion between July and January from a year ago. Surge is a sudden, large increase. Here, remittances grew by $5 billion compared to the same period last year. The January gap slashes the accumulated current account surplus from $1.2 billion to $628 million, still significant progress from the deficit of $1.8 billion posted in the same period last year, spawning hopes that the current account surplus/deficit will remain range-bound between plus 0.5 PC and -0.5 PC of GDP during FY25. Slashes means drastically reduces. The sentence shows that the previous surplus shrank from $1.2 billion to $628 million, which is an improvement over a previous deficit of $1.8 billion. Range-bound implies that the balance is expected to stay within a narrow margin between plus 0.5% and minus 0.5% of GDP during fiscal year 2025. The gap in the current account is not surprising, given the 38 PC decline in foreign loan inflows to $4.58 billion in the first 7 months of the present fiscal year, from $6.31 billion a year ago. 38 PC decline means a 38% drop. Foreign loan inflows refer to money borrowed from abroad. The figures indicate a decrease from $6.31 billion to $4.58 billion, which helps explain the current deficit. In its monthly report, the Economic Affairs Division said that the external assistance does not include the $1 billion received from the IMF under its funding program. This clarifies that the reported figures exclude the additional $1 billion received from the International Monetary Fund, IMF, meaning overall external support is even broader than the loan figures suggest. The government is targeting foreign debt inflows of $19.4 billion, including $9 billion from China and Saudi Arabia this fiscal year. Foreign debt inflows refer to the total amount of money the government plans to borrow from international sources, with significant portions expected from China and Saudi Arabia. Though FDI has risen by 27 PC to $1.3 billion in the first half of the year, the meager amount underlines the lack of investor confidence amid our painfully slow progress on structural reforms. FDI stands for Foreign Direct Investment. A 27% rise to $1.3 billion is noted. However, meager implies that the figure is still very low, reflecting weak investor confidence due to slow structural reforms. And even after the passage of 2 years, the promised investment flows from the Gulf remain elusive. Promised in quotes indicates skepticism about the commitment. Elusive means they have not materialized, emphasizing ongoing disappointment in expected Gulf investments. The weakened financial account indicates that debt payments and a surging trade gap of over $16 billion is mostly being financed through the current account. Weakened financial account means the part of the balance of payments dealing with capital flows is underperforming. A surging trade gap of over $16 billion implies a large imbalance between exports and imports, which is being covered by borrowing through the current account. The empty financial account is also responsible for a reduction of $1 billion in the state bank's international reserves in 8 weeks, from December 13th to February 7th, despite the purchase of $3.8 billion from the market in July-October. Empty suggests that capital inflows are insufficient. The sentence explains that despite a $3.8 billion purchase in earlier months, the state bank's reserves fell by $1 billion in a short period, highlighting ongoing financial vulnerabilities. The alarm being raised by some analysts is premature. Premature means coming too early. This suggests that the current concerns may be overblown or temporary. It is anticipated that debt payment pressures will subside as most maturing loans have already been paid and imports are expected to slow down. Anticipated means expected. This predicts that as loans mature and imports decrease, the pressure on the current account will ease. If the momentum in remittances continues, we might see a small surplus in the current account. Momentum implies sustained high levels. A small surplus would mean a slight positive balance if remittances remain strong. Aside from a natural gradual depreciation in the rupee value, there is also no reason for the exchange rate to deteriorate steeply. Gradual depreciation means the rupee is expected to lose value slowly over time. The sentence argues that apart from this natural trend, the exchange rate should remain stable. That said, the fragility of economic recovery demands that the authorities stop relying on remittances to finance the current account deficit and focus on attracting non-debt-creating foreign private investment. Fragility means vulnerability. The sentence criticizes the over-reliance on remittances and urges the government to attract foreign investment that does not increase debt. Improvement in headline inflation, leading to a fall in interest rates and reserves, besides a stable currency, has given policymakers a chance to fix investment policies and implement structural reforms. Headline inflation is the overall inflation rate. A reduction in inflation leading to lower interest rates and stable reserves provides a favorable environment for policy reform. The window for changing course is small and time is running out. Window for changing course is an idiom meaning a limited opportunity to make effective changes. Time is running out emphasizes urgency. Published in Dawn, February 20th, 2025,